Right, now the other part here is the fixed overhead part. So again, just by its name, fixed overhead part, supposedly it should not change regardless of the outputs. Okay, fixed cost, remember, for all these different level of outputs, it's supposed to be the same level, unless in reality perhaps we might have purchased additional machinery that wasn't what we planned. If some of the machinery broke down, we sold it out to secondhand market, we purchased additional machinery, then this will obviously boost up the cost of fixed overhead, especially if it's straight line depreciation. Okay, so here we still see that there's a differences here, which means there's something that managers need to look into, why there was an increase in the actual outputs. So supposedly it should be 9,600 all throughout different units of outputs. This should be a standard cost. That doesn't change, but we see that there's 12,300 here. Okay, so this part here is a little bit different from all the prior categories. This $2,700 unfavorable cost differences, we consider them all together and we call it spending variances. Okay, so meaning that earlier what we have been doing is breaking down different costs into two different categories, and both of these are considered flexible budget variance, right? But now for the very last category here, make sure you understand that this 2,700 is already the total flexible budget variance for a fixed overhead. We call it spending variances. We don't further break that down into different categories. So what the spending variances means is, in reality, the differences between what we actually spent and with the flexible budget, 9,600. Okay. So what this 2,400 means, you can just understand it as using the standard cost that we used earlier times the total allowable hours. Remember, 4,000 hours was allowed for 10,000 DVD outputs. Supposedly, the cost could have been bumped into 12,000 units, $12,000 of cost. But because we consider this as fixed costs, it should have, theoretically, it should be 9,600 all throughout. Okay, the actual one, we spent 12,300. This is the spending variances. We call the actual and the flexible budget differences spending variances. What we call volume variance for fixed overhead here, we're just comparing the 9,600 against what could have happened if we used still the standard price for the fixed overhead, which is $3, times the 4,000 hours that workers could have been using. Okay, this part here, it may be a little bit tricky to understand, but basically, first part, spending variance, is just the difference, the total sum amount between the actual and flexible. That would be spending variance. What volume variance is showing that if we use the standard price, the fixed price that we spread it to each and every hour, and use this, apply it to the possible hours that could have been spent by the workers, then altogether it's possible that we could have spent $12,000. Okay, but we budgeted for 9,600 in the beginning. We could have, that was for 8,000 units. But for 10,000 units, we could have been budgeting $12,000. So that difference is we call a volume variance. It's just because the 8,000 and 10,000 differences. And we have this variance showed here. Okay, probably you're all confused now. We're going to do an exercise on this later. Just remember that for the very last category, this is the only part that's considered flexible budget variance. Okay, this part we just call it volume variance. It's really not part of flexible budget variance. Okay, it's still part of volume.
As long as the spending variance is more than the volume, it's going to always be unfavorable.
As long as the spending is more than the flexible budget, then this part here, yes, is unfavorable. And then overall depends on this. Okay, when we talk about fixed overhead variance, whether it's still favorable or unfavorable, that depends on how much this is. So this part here assumes that if the workers actually worked in full 4,000 hours, then the fixed overhead cost could have been $12,000. The original static budget could have changed to $12,000. Okay, so this volume variance is favorable because the actual spending, the flexible budget, we set it as 9,600. So we had 2,400 favorable here. Added with the unfavorable, overall we have $300 still as unfavorable, but it was a lot less than this part here. Okay, let's work on an exercise a little bit later just to make sure that we're on the same page. This basically just shows where I got this 3 from. So I was just worried that if you don't know where that $3 is from, that was from the original standard price that we got earlier.